Okay, you all back. So, first of all, thank you very much for your answer. I can see some of you submit the answers very quick. Yeah. But now we're gonna check how we're gonna deal with these problems and whether you have good answer or not. Okay. So first of all, I will interpret the problems and I will ask different group to give me the answer or the explanation for what we're gonna do, right? The Universal Laser Inc. just paid a dividend of $2.9, yeah, on its stocks. The growth rate in dividend is expected to be a constant 6% per year indefinitely, right? The investor require 15% return on the stock for the first 3 years and 13% return for the next 3 years, and then 11% thereafter. Okay, so you will have to estimate the current price. So I will post the thing on my my Excel file, and I think it will be easier for us to follow. Okay, and even estimate as well. So the first case right here, the just paid dividend just paid, that means dividend in year 0, yeah, 2.9, and the dividend grow at the rate of 6%. So that means it will be that much multiplied by 1 plus 6%. Okay, 6% to the power of 1. Okay, so I will fix this number. Yeah, let me fix this number. Otherwise, I think it's not really important. So it's still going for the other part as well. Yeah, it's continued because the here we have the word indefinitely. That means the growth rate, sorry, the cash flow will be in forever, yeah, in the infinity. Well, so basically, when you estimate the present value or the current price of the stock, we will take this number, yeah, which is the dividend in year 1, then divided by R minus G. Yeah, this is the way we're gonna do. We're gonna do with this case, right? Dividend. Dividend number 1 to be exact, right? Dividend in year 1 is that much, right? The grow 6%. Now, there are the case that I already mentioned earlier, yeah, that we may have different discount rate at different time, right? This different discount rate. Okay, then you find out that the investor require different return on our stock, right, in different year. I will like group 1. You know the number of your group yet? I think I already mentioned, but let's see. Oops. You didn't write of your group number. So this will be a bit difficult for me, but no worry. Yeah, just some of you, the other group still state their group number, right? Now I would like to ask group group 1, yeah, could you please interpret or explain the way you're gonna do with this one, with this problem, yeah, when you estimate the current price.
We will calculate the price of the stock in year 6 because that when the rate of return and the growth rate are constant.
Okay.
11% and 6%.
11%. Okay.
Yeah.
Right. So you start with year 6, right?
Yeah.
Right. So what you gonna do?
We're gonna calculate the present value of the stock in year 6.
Yeah. So what is the formula that you use to estimate the present value in year 6?
I use the can I calculate it? Can I copy it in the box chat?
All right. But I would like you to interpret. You explain why you do so.
Because from year 6 is the cash flow will be the growing perpetuity. So we use the formula for growing perpetuity.
Okay, well, that's great then. Okay, so right here, we're gonna have the price in year 6, right? Price in year 6. The price in year 6 will be equal to
dividend in year 7.
Yeah, dividend in year 7.
Yeah, divided by the rate of return minus the growth rate in dividend.
Yeah. So what is a growth rate? What is the dividend that you use right here?
We use the 2.9 power by 1.06. Em nói tiếng Việt được không ạ? Cái mũ này em quên tiếng Anh.
1.96.
2,9 nhân với 1,0647 ấy.
Yeah, so it's already right here.
Yeah.
Okay. Okay, so I think it's gonna have you to get some terms, mathematic English terms. Okay, so when you estimate the present value, first of all, you're gonna estimate the price of stock in year 6, yeah, and the price of the stock in year 6 will be equal to the the present value of growing perpetuity, yeah, of dividend, yeah, from year 7, right? And in order to estimate this one, you will need to use the dividend in year 7, yeah, divided by the required return, yeah, minus the growth rate in dividend. Okay, So we divide by the whole part right here, right? The dividend in year 7 equal to dividend in year 6. Yeah, in year 6, yeah, multiplied by 1 plus roll rate, yeah, to the power of 7. Okay, yeah. So if you have to say, you're gonna say in such way. So the dividend in year 6. Oops, sorry. This should be the dividend in year 0, right? Year 0. Sorry. So it will equal to 2.9 divided by 1 plus 6%, yeah, to the power of 7 divided by roll rate 11% minus 6%. Okay, how much is it? The numbers right here we say is P6. How much is it? Hello? Okay, thank you, Kian. 87.121. Okay, now what we're gonna do next?
We're gonna calculate the price of stock in year 3.
Okay, price of stock in year 3. So how many cash flow that we get from year 3 when
we think that is there for cash flow, the present value of dividend in year 4, 5, 6, and the present of stock price in year 6.
Okay, the present value of dividend year 4 and 5 and 6 plus the present value of the price in year 6, right? So from year 3 to year 6 we have 3 periods. Okay, then the numbers that we have right here is 2.9, yeah, multiplied by 1 plus 6% to the power of 4, right? And then we divided by, here's the whole terms right here is a dividend in year 4, right? Now we have to convert to year to year 3. It's become 1.13. Okay, then plus the same part right here, but now the power will be different. The powers right here will be the power of 5 and 1.13. We're gonna have to make the power of 2. Okay, so here we have the power of 6, power of 3, and also the last number, which is P6. Our P6 right here, we need to divide by 1 plus 1.13 to the power of 3, right? Then we're going to have the price. Yeah, you may find out that we use different different discount rate, right? In the previous part we used the discount rate of 11, right? But here we use the discount rate of 13, right? 13, yeah, in our calculation. Why is that? because you find out that in the next 3 years, yeah, from year 4 to year 6, the required rate is 13. Okay, so you're gonna get the numbers right here, 69.1.57. Okay, and from now on we can estimate the cash flow in year 0. Okay, so we do the same, but now we move, we estimate the dividend from year 1, 2, and 3. Okay, and also the present value of P3, right? So then I'm gonna copy this one because it's quite similar, right? The main difference is the power, yeah. The first one will have the power of 1, right? Because the dividends right here is dividend year 1. This part is dividend in year 2, so it's power of 2, power of 3, power of 3. Okay, and I'm gonna pick up this number, which is our present value in year 3, to such point. The other thing that we have to change in our formula, yeah, is our discount rate. Yeah, it's become 15. It's not 30 anymore. Okay, so we're gonna get the current price, yeah, with 3 steps like this. Group 2, could you please give me the result of P0? How much is it? Group 2, please.
Sorry, teacher, but my group did have a wrong answer for this exercise.
Okay, well, then group 3, please. Group 2, where did you get the wrong one? Do you find your mistake, yeah, with my explanation right here? Group 3, where are you? Okay, thank you very much. So thank you, the first 3 group. So group 2, if you got the wrong answer, could you please double check, yeah, whether you got the wrong approach somewhere. This is exercise number 6, right? With this exercise, you find out that the different discount rate, yeah, was used, right? 11, 13, and 15, right? The next one relating to the non-constant row, non-constant growth. You find out that there are no dividend was paid, yeah, on the next 9 years, yeah, because the firm need to flow back the earnings to fuel growth, right? So it seems that there are no dividend policy in the first 9 years, right? And then from year 10, the company will pay the dividend that much per share, right? And expect to increase the dividend by 5.5% years after. So we're gonna have 2 different parts, two different parts. Okay, so group 4, Hello, group 4. Could you please interpret or the process that you're gonna do with exercise 7? Hello, group 4.
Cô đợi em tí. Trình bày cách làm mà cô hay là ghi
Yes.
đáp án ạ?
Interpretation.
Đầu tiên là tính P của 5 thứ 9 ạ.
Okay.
Nhóm em để em trình bày nhóm đấy, nó tính P của 5 thứ 9 xong rồi là nó ra xong rồi là tính P0 luôn thôi ạ.
You may have the cash flow in such way. This is the first cash flow, right? 1 and 2 and 3 and 4 and 5 and 6 and 7, 9, 9 and 10, yeah. And we may add one more cash flow, and 10 and so on, right? So the first cash flow will start from here in year 10, right? So well, we're gonna have the first cash flow right here, $7.5, okay? And then that also means start from year 10, we're gonna have growing annuity, right? This is growing annuity. So all the growing annuity from year 10 here, when we convert to present, it's become the price in year 9. Okay, right? So when we get the price in year 9, you will convert once again to get the price in year 0. So two steps that you will apply right here, P9 equal to the dividend that
Year 10.
Yeah.
Divide.
Okay, be paid in year 10, right? Divided by
Discount rate minus
roll rate. Okay, 12% divided by 5.5%. Okay, how much is that?
269.23.
Yeah, 269.23. Okay, and now we have to estimate P0. We don't have any cash flow, yeah, in between, so we just convert only one cash flow in year 9 back in time. So it's become P9 divided by
1.13.
1 plus 12%. Okay. I can see that you understand the thing, but you couldn't speak in English.
Yes.
Right. Okay. So we have to work harder on this. Okay. So how much? The final answer, please.
240.39.
240.39. Are you sure?
Yes.
Let me check. It seems not the correct answer.
Thiếu mũ 9 thì sao vậy ạ?
Không, cái này nhóm
Yeah.
bị
Yeah,
thiếu mũ 9 ạ.
to the power of, yeah, of 9, sorry. To the power of 9. This is 2.
Đáp án ra là 89,62 ạ.
Yeah. Okay, thank you.
Nó phải là 97,09.
Yeah, the correct answers will be 97.09.
Yep.
Okay, thank you very much. This is exercise 7. The other one right here, we go with the non-constant dividend, right? Non-constant dividend right here is a type of dividend that in the first part, the dividend will grow but increase. Well, this is not raw dividend, right? You find out that just paid dividend is $9 per share and increase by 4 per share for the next 5 years, right? And will never pay the dividend. So actually, you find out that this is only 5 cash flow, right? Only 5 cash flow. Could I ask group 5 for the answer? Group 5, are you there?
Yes, we have 5 cash flow. For the first year is 9.
Yeah, first year 9.
9. Second year is 13.
13.
Yeah. For the third year is 17.
17.
Fourth year is 21. And the fifth year is 25.
25. Yeah. The other group, do you agree with the cash flow?
We calculate for the PV and we calculate it is 72.45.
Okay. Well, but before we go into details, just look at the cash flow first, right? You find out that we already have 2 examples. Yeah, when I say the company just paid dividend $9 per share. The $9 per share is right here is the dividend in year 1 or dividend in year 0. Which year, please?
Sorry, we have a mistake. The first PO is 9.
Okay, so here will be our cash flow, right? And
Yes.
Yeah. Then the cash flow in year 5 will be 29. Okay. So with this information, what is the price? Price P0 will be the present value of stream of dividend from which year to which year, please? Group 5, please. Could you continue your flow?
It's from year 1 to year 5.
Okay, from year 1 to year 5, right? So we only care about the cash flow here from year 1 to year 5, right? And when you discount every cash flow, and right here you find out that we don't have the regulation, any regulation for the cash flow, such as the simplification. So what you have to do is you will have to estimate one by one, right? Manually. For example, the cash flow in year 1, you will have to convert to present, yeah, using this formula, right? The second, 17 divided by 1.12 to the power of 2. And we do the same for the other, okay? Right, so when you sum up, you're gonna have the present value. So and just the example. Okay, so be careful with this number, right? I just say a lot of people make mistake. It's not it's this very, very popular mistake. So could you please make sure that you read the information carefully, right? The last one, please, could I ask the group number 6, what you're gonna do with this example, with this problem?
We haven't done the exercise 9 yet.
Okay. All right, so could you please read the information and think of which approach that we're gonna use for this exercise. Yeah, you see the company is experiencing rapid growth. The dividend are expected to grow 30% per year during the first 3 years. Yeah, and then 18% over the following year, and then 8%. Could you please draw the timeline? I will copy this one. Could you please draw the timeline for us? Yeah, draw the timeline. See. Can you please answer me? Several questions. First of all, what is P0?
It's 60.
Huh?
60.
65, right? We have 65 right here. Okay, yeah. The dividend, the projected dividend, that means the dividend in year 0. Sorry, dividend in year 1 is the number that you will have to estimate, right? If we have the dividend in year 1 is dividend 1, then the dividend in year 2 will be
Is dividend in year 1 multiply 30%.
okay. So the dividend in year 1 multiplied by 1.3. 1.3. Thank you. Right. What is the dividend in year 2? Sorry, in year 3. You can find it will be the power of 2. Thank you. Thank you, group 6. Now could I ask group 7? Are you there? What is the dividend in year 4?
Dividend in year 4 equal to dividend in year 1 multiply 1.3.
Dividend in year 4 multiplied by 1.3. Is it?
No. Power of 3.
To the power of 3. To the power of 3.
And multiply 1.18.
1.18. 1.18. Right. Then you find out that from year 4, the dividend will grow at the rate of 18%. 18%. So we're gonna start with dividend in year 3 multiplied by 1.18, right? 1.18. Okay. So actually, it's not the power of 3. It's only power of 2. Okay. So it will be that much. Then multiply by 1 plus 18%. Okay. So could you please be careful with the point, right? So see, dividend in year 1 multiplied by 1.3 to the power of 2 is already the dividend in year 3. Okay. And then if we start with the dividend in year 3, then dividend in year 4 will be dividend in year 3 multiplied by 1.18. Okay. Then in the next year, dividend in year 5, could I ask group 9, what is the dividend in year 5? Group 9?
Is equal to dividend of year 4 multiply 1.8. 1.08.
Yeah, 1.08. Yeah, because after that year you find out that the growth rate is 8%. Yeah, indefinitely, right? So we have several formulas right here to get. Yeah, so the dividend in year 5 will be equal to dividend in year 4, which is that much. Then multiply by 1.06. Okay, so from year 5, then you find out that we have the growing perpetuity in such way, right? Then in order to get the present value in year 4, which is P4, the price of the stock in year 4, we gonna get that much money, right? Which is the dividend in year 5, right? And then divided by R minus G. Yeah, R minus G. Which is our discount rate. Group 1, please. Group 1, please. Hello.
I'm sorry, can you repeat the question?
I'm asking for the discount rate. What is discount rate? Hello? Are you there?
11%.
Yeah, thank you very much. So what is the growth rate that we're going to use in such case?
This is year 4, so 18%, right?
No.
Oh.
8%.
Yeah, 8%, because we are discount this cash flow. We are discounting this period, right, from year 5. So from year 5 to forever, the growth rate is 8%. Okay, you please be careful with the thing. Right. So yeah, we're gonna apply this one and come back to P0. Yeah, P0, which is our current price. Yeah, we have the current price that much, right? And now we're gonna replace all the cash flow to the thing right here, right? We're gonna discount the cash flow in year 1, D0. D0 convert to present. We're gonna get D1 when convert to present, it will be equal to D1 divided by 1 plus the discount rate what is the discount rate that we use? 11%, right? 1.11, okay, plus the dividend in year two, right here, divided by 1.11 to the power of 2, okay, and the dividend in year three to the power of 2, sorry, into the power of 3, okay, and we have the cash flow in year 4, which is that much money, right, divided by 1.11 to the power of 4, okay, and the last one, that last one is the whole stream of cash flow from year 5, and it's already equal to that much, right? So I'm going to copy this one just right here. Oh, I just keep P4, right, divided by 1.11 to the power of how many period that we're going to put right here?
4.
Yeah, 4. Okay, so I'm going to replace P4 by the whole term. Okay, so you find out that the whole thing in the right hand side, right, which is equal to 65, okay, then you're going to get the number of the dividend in year 1, okay. Right now, right here, they are asking the projected dividend in the coming year, which is the dividend in year 1, right? If we change the question, you are asking to estimate the current dividend or the just paid dividend. Just paid dividend. If it's just paid dividend, then it will be the just paid dividend will multiply by 1.3 and it's equal to D1, right? So it depends on the question, and be careful of the point you require to estimate. All right, any question before we move on? Do you have any question?
No.
Okay, so we already spent so much time on this part, right? Now let's talk about the parameters, right? As I told you at the very beginning, right here, oh, I erased already. I told you that when we apply all the formula, yeah, we need to know what is our discount rate, what is our roll rate, right? For every formula, yeah, our formula. You see, even in the first case, we need the discount rate, which is our parameters, right? For the second case, when we talk about the constant roll rate, we also need the discount rate R and also the roll rate G, right? For the differential growth, we need this number as well, right? So we call all of this number is the parameters, yeah, of our model, okay? And in reality, no one gonna give you the number, yeah. You may realize that from chapter 3 to 4, yeah, you normally given the discount rate, you are given the growth rate, okay? But in reality, no one gonna give you any number, so you're gonna have to figure it out, yeah, by yourself, right? So I'm gonna show you how we're gonna get that, yeah. The parameters in our calculations will be the growth rate G and also the discount rate R. Discount rate R. Now let's do the explanation, right? Roll rate. How can we get the roll rate? Roll rate talking about the development, yeah, of the company, right? Of the company. So normally we're gonna look at the earnings of the company. We compare the earnings of the company next year and the earning this year. Okay, so to see how different are there, how different our scale, right? The earnings next year divided by the earnings this year, yeah, -1. We're gonna have the roll rate, right? To make it simple for you, if we investigate the earning next year, yeah, it will be equal to the earning this year, then plus any increase in earnings, right? So any increase in earnings, it will be a level of growth, right? And if we put in our calculation, the divisions right here, yeah, earnings next year divided by earnings this year -1, then we have the growth rate. We have the growth rate, right? So here we have the case, right? Now I'm gonna expand the formulas right here. Where's increase in earnings come from? When the company have earning, yeah, the net income, the company will distribute to the shareholder as a dividend payment, right? And the other part will come back to the company, right? And be reinvested, right? So the reinvested amount of money will be will increase our earnings, yeah, for the next year. Okay, so I say the earning next year will equal to earning this year, yeah, then plus any returns on retained earnings, right? Because when the retained earnings come back to the company for reinvestment, we're gonna get profit, yeah, from the retained earnings. Okay, so here an increase in earnings, yeah, actually the return on retained earnings. Okay, right? So we have the case that need to get right here, right? So what we do now, I'm gonna divide both sides with the earnings this year. You see the difference? Yeah, I divide the left-hand side by the earning this year, and also here with the earning this year, right? Earning this year. Okay, well, so you find out that earning this year divided by earning this year equal to 1. Okay, so now we rearrange the formula. Yeah, I'm gonna rearrange 1 in the left-hand side, right? So you find out that earning next year divided by earning this year -1 will equal to that much. Right? So actually, I told you at the beginning, earning next year divided by earning this year -1 will be our growth rate. Okay, so now it's turned out that our growth rate will equal to return on retained earnings divided by the earning this year. earning this year. Where's my file? Okay, so what is the return on retained earning? Return on retained earnings will equal to the retention ratio sorry, I think I'm gonna put the retained earnings. This is amount of money, right? And return on retained earnings actually the percent, right? The ratio. So we need to put it right here. Yeah, put it right here. See. Now we rearrange the formula. Retained earnings, yeah, divided by earning this year, yeah, then multiply by the return on retained earnings. This number, the retained earnings divided by the earnings this year, we call this number retention ratio. Yeah, the percentage of the return of the reinvestment, yeah, of the company, right? We call them the retention ratio, right? So if we start from this thing, we find out that growth rate equal to earnings next year minus earning this year minus 1. It's quite difficult for you to get this number because it's projected, right? However, it turned out that a growth rate equal to retention ratio. Retention ratio you can get from your financial reports, right? And also we have the return on the retained earnings. Yeah. In fact, it's very difficult for you to get the return on retained earnings. However, the retained earnings is the part of our equity. Okay, so instead we're gonna use the return on equity, okay, which is the ratio, yeah, to see the effective of our efficiency of our performance. Okay, this number, yeah, the ROE, right? See, ROE. This is also reported, yeah, in our financial report. Okay, so it turned out that it's very easy for you to find these two number, yeah, and you can get the growth rate, right? So you may see that, yeah, theoretically the growth rate will equal to the retention ratio multiplied by return on retained earnings. Okay. However, because this number is very difficult to find, so we're gonna use the ROE instead. Okay. The retained earnings is a part of our equity. Yeah, that's the reason why it shares the same characteristic. Then we're gonna use the ROE instead. Okay. Relating to the discount rate, R. Discount rate R can be broken down into two different parts, right? Dividend yield and growth rate. Okay, the dividend yield and growth rate. I'm gonna show you how can we get that thing. Yeah, if we start with the dividend growth model, okay. So P0 will be equal to dividend in year 1 divided by 1 by R minus G. Okay, this is what we have just learned, right? We call the dividend growth model, okay, or constant growth model. It's the same thing, right? Then now we rearrange and we get the discount rate R now equal to dividend in year 1 divided by P. Yeah, these two numbers you can also get from financial report as well. And you get the dividend yield 1 divided by P0 dividend yield. Dividend yield, right? And G is right here, the capital gain yield or the growth rate. Yeah, the growth rate. Yeah. And also we can call them as the dividend yield, right? So this is the way, these two numbers you can get from financial report, right? So now I have just shown you the way that you can get the discount rate and how we can get the growth rate. For the comparable and the stock market, I think you can read by yourself, right? The comparable you will learn in advance in firm valuation module, okay? And stock market, you're gonna have the whole subject relating to stock market and the stock or investment analysis, right? So could you please read these two parts at home, right? The main part relating to stock valuation, we already done, okay? I show you different type of common stock, right? And the way we can deal with different stock, right? And also I introduce you, yeah, I show you the technique to get the parameters for all the models. Yeah, this is where two key parts I would like to share with you today, right? These two parts is not very important for the examination, so you can read by yourself, right? So I think we can complete chapter 5. Yeah, chapter 6, sorry, chapter 6 with stock valuations right here. You can do all exercises, yeah, on your own, right? And next week we're gonna have exercise solution, yeah, a seminar on Wednesday, yeah, on Wednesday. And then Thursday we're gonna move on with the last chapter, risk and return. You have any question?
Em có một số bạn hỏi cách tính điểm chuyên cần ở môn này thế nào ạ?
Bạn nào còn nhớ cách cô nói